Hey, welcome to Money Mastery 365. I'm Valentine Elias, here to help you unlock your financial potential every day. Today we're diving into a key aspect of financial planning that can transform your journey to financial freedom. Let's get started. Stocks, bonds, mutual funds, what's the difference? These terms can be quite confusing, right? But don't worry, we're here to simplify things for you. If you're confused by these terms, you're not alone. Many people find the world of investments overwhelming, but understanding these concepts is crucial for making informed financial decisions. Let's break them down and help you make smarter investment choices. Understanding these basics can set you on the path to financial success. So let's dive right in. First up, let's talk about stocks. When you buy a stock, you're buying a piece of a company. Essentially, you become a part owner of that company. This ownership gives you a claim on part of the company's assets and earnings. It's like owning a slice of pizza. The more slices you own, the bigger your share of the pizza. And just like pizza, the value of your slice can change over time. Stocks offer the potential for growth, but they also come with higher risk. The value of your investment can go up and down. This fluctuation is due to various factors, including market conditions and company performance. The company's performance directly affects your investment. If the company does well, your stock value increases. If not, it decreases. It's important to research and choose companies with strong growth potential. Next, we have bonds. Think of bonds as loans you give to organizations like governments or corporations. They borrow your money and promise to pay it back with interest. This makes bonds a form of debt investment. And in return, you get interest payments. These payments are usually made at regular intervals. The interest rate and payment schedule are typically fixed, providing a predictable income stream. Bonds provide more predictable returns and are generally lower risk compared to stocks. They are considered safer investments. However, the returns are usually lower than those of stocks. So if you're looking for stability, bonds might be your go-to. They can be a great way to preserve capital while earning some interest. This makes them ideal for conservative investors or those nearing retirement. Now let's talk about mutual funds. These are pooled investments managed by professionals. When you invest in a mutual fund, your money is combined with that of other investors. This pooled money is then used to buy a diversified portfolio of stocks, bonds, or other securities. Imagine a basket filled with various stocks and bonds. This diversification helps spread risk. By investing in a mutual fund, you don't have to worry about picking individual stocks or bonds. With mutual funds, you benefit from diversification and professional management. The fund manager makes investment decisions on your behalf, aiming to achieve the fund's investment objectives. The risk and reward can vary depending on the fund's holdings. Some funds are more aggressive, while others are more conservative. It's important to choose a fund that aligns with your risk tolerance and investment goals. And there's also ETFs, or exchange-traded funds. They are quite similar to mutual funds but are traded like stocks on the exchange. This means you can buy and sell them throughout the trading day. ETFs offer the best of both worlds, diversification and liquidity. They offer flexibility and can be a great addition to your investment portfolio. ETFs often have lower fees compared to mutual funds, making them a cost-effective option for many investors. So, when should you choose each type? Let's break it down. If you're aiming for high growth and can handle some risk, stocks are your friend. They offer the potential for significant returns. However, be prepared for volatility and the possibility of losing some or all of your investment. For steady, predictable income, bonds are a solid choice. They provide regular interest payments and are less volatile. This makes them suitable for risk-averse investors or those seeking a reliable income stream. And if you want to mix with professional oversight, mutual funds or ETFs might be your best bet. They offer diversification and are managed by experts. This can help you achieve a balanced portfolio with a mix of growth and income. Now let's hear from you. We love engaging with our community. Your insights and experiences are invaluable to us. Which of these investment types seems most interesting or appealing to you right now? And why? Your feedback helps us create better content. We want to know what you're thinking on that. Share your thoughts in the comments. We read every single one. Your input is crucial for us to improve and provide the content you need. Feeling more confident about the basics of stocks, bonds, and mutual funds? We hope this video has been helpful. Remember, knowledge is power when it comes to investing. Your support means a lot to us. It helps us continue to provide valuable content. Do you have any initial questions about these investment types? Tell us below. We're here to help. No question is too small or too big. Next up, we'll explore the power of compound interest, the magical force that can significantly grow your investments over time. You won't want to miss it. It's one of the most powerful concepts in finance. Check the video out in our library. If you've stayed with us this long, it shows you're truly committed to growing your financial knowledge and investing wisely. In this segment, we'll answer all your questions and dive into a practical strategy to help you generate £1,000 or $1,000 a month through investing. Imagine having a steady stream of passive income flowing into your account every month. Sounds great, right? One way to achieve this is by investing in dividend stocks. Dividend stocks are shares of companies that regularly distribute a portion of their profits to shareholders in the form of dividends. This can provide a consistent income stream, making it an attractive option for many investors. But how much do you need to invest to make $1,000 or £1,000 a month? Let's break it down. Suppose you aim for a 4% dividend yield, which is a reasonable target for many dividend-paying stocks. To generate £1,000 a month or £12,000 a year, you would need a portfolio worth £300,000. Yes, that's a substantial upfront investment, but it's important to remember that this approach offers long-term benefits. Building a portfolio of £300,000 might seem daunting, but it's achievable with disciplined saving and investing over time. Start by researching and selecting high-quality dividend stocks. Look for companies with a strong track record of paying and increasing dividends. Diversify your investments across different sectors to spread risk. Once you have your portfolio set up, the key is to stay patient and let your investments grow. Reinvest the dividends to take advantage of compounding. Over time, your portfolio will grow and so will your monthly income. It's also worth noting that dividend stocks can offer additional benefits. Aside from the regular income, they often provide potential for capital appreciation. This means your investment can grow in value, giving you a double benefit of income and growth. So, is investing in dividend stocks the right strategy for you? It depends on your financial goals, risk tolerance, and investment timeline. If you're looking for a reliable source of passive income and are willing to invest for the long term, dividend stocks can be a powerful tool in your investment arsenal. We'd love to hear from you. Are you interested in dividend investing? Do you have any favorite dividend stocks? Share your thoughts in the comments below. Your experiences and insights can help others on their investment journey. If you found this video helpful, don't forget to like, share, and subscribe for more investment tips and strategies. Your support helps us bring you more valuable content. Stay tuned for our next video on the power of compound interest. You will find this video in our library. It's a game changer you won't want to miss. In this segment, we're addressing a common question. Is it too late to start investing at 50? If you're 50 or older and haven't started saving for retirement, don't worry, it's not too late. While it may seem daunting, with the right strategy, you can still build a comfortable nest egg for your golden years. First, focus on maximizing your contributions to retirement accounts. Take advantage of catch-up contributions available for 401(k)s and IRAs. These allow you to contribute more than the standard limit, which can significantly boost your retirement savings. Next, consider reducing your expenses. Cutting back on unnecessary spending can free up more money to invest. This might mean downsizing your home, eliminating debt, or adopting a more frugal lifestyle. Small changes can add up over time and make a big difference in your financial future. Another option to strengthen your savings is to delay retirement or work part-time. Working a few extra years can not only increase your savings but also reduce the number of years you'll need to rely on them. Additionally, continuing to work can provide you with healthcare benefits and other perks, easing the financial burden of retirement. Investing wisely is crucial at this stage. Focus on a balanced portfolio that aligns with your risk tolerance and investment goals. Diversifying your investments can help manage risk and provide more stable returns. Consider consulting a financial advisor to create a personalized investment plan tailored to your needs. Remember, it's never too late to start investing. The key is to take action now and stay committed to your financial goals. With discipline and strategic planning, you can still achieve a comfortable and secure retirement. We'd love to hear from you. Are you starting to invest later in life? What strategies are you using to catch up on your retirement savings? Share your thoughts in the comments below. Your experiences and insights can help others who are in the same boat. Your support helps us bring you more valuable content. Stay tuned for our next video on the power of compound interest. It's a game changer you won't want to miss. Moving on, we're tackling a crucial question for many investors. What is the safest investment with the highest return? When it comes to safety, US Treasuries are often considered the gold standard. Backed by the full faith and credit of the US government, these securities are virtually free from credit risk. This makes them an attractive option for conservative investors seeking stability. But what about returns? While US Treasuries are incredibly safe, their returns are generally lower compared to other investment options. However, they offer a reliable stream of income, especially in uncertain economic times. There are different types of US Treasuries to consider. Treasury bills, T-bills, are short-term securities that mature in 1 year or less. Treasury notes, T-notes, have maturities ranging from 2 to 10 years, while Treasury bonds, T-bonds, have the longest maturities up to 30 years. Each type has its own yield and maturity profile, allowing investors to choose based on their specific needs and time horizons. For those looking to balance safety with a bit more yield, consider Treasury inflation-protected securities. Tips. These are designed to protect against inflation as their principal value adjusts with changes in the Consumer Price Index, CPI. This can provide a hedge against rising prices while maintaining the security of a US Treasury investment. It's important to remember, though, that no investment is entirely without risk. While US Treasuries are extremely safe in terms of credit risk, they are still subject to interest rate risk. As interest rates rise, the value of existing bonds can decrease. That's why it's crucial to consider your overall investment strategy and risk tolerance when choosing the best investment for your needs. We hope this segment has shed some light on the safest investments available. If you have any questions or need further clarification, feel free to drop a comment below. We love hearing from you. And as always, if you found this video helpful, don't forget to like, share, and subscribe for more investment insights and tips. Your support helps us continue to bring you valuable content. Stay tuned for our next video, where we'll dive into the power of compound interest. It's a game changer you won't want to miss. Now that we've discussed some excellent stock options for beginners with little money, let's tackle a question that's on many minds. Should you pull your money out of the stock market during a recession? It's natural to feel anxious when you see the market dipping and your investments losing value. However, it may make more sense to focus on the long term, despite the current pain. Recessions are part of the economic cycle, and historically, the stock market has always rebounded over time. Selling your investments in the current downturn will likely ensure you have a loss. When you pull out your money, you lock in your losses and miss the opportunity for recovery when the market bounces back. It's crucial to remember that investing is a long-term game, and temporary downturns shouldn't dictate your strategy. Instead, consider using this time to review your portfolio. Are your investments still aligned with your goals and risk tolerance? If so, it might be best to stay the course. If not, this could be an opportunity to make adjustments, but do so thoughtfully and not out of fear. Diversification is another key factor to consider. Having a mix of assets can help cushion the blow during market downturns. Bonds, real estate, and other asset classes can provide stability when stocks are volatile. In summary, while it might be tempting to pull your money out of the stock market during a recession, focusing on the long term and maintaining a diversified portfolio can help you navigate through the tough times. We hope this segment has provided you with some valuable insights into managing your investments during a recession. If you have any questions or need further clarification, feel free to drop a comment below. We love hearing from you. Now that we've discussed whether to pull your money out of the stock market during a recession, let's dive into an intriguing topic: how to double your money in a month. First, let's set realistic expectations. Doubling your money in such a short period is extremely challenging and involves high risk. While it's possible through speculative investments like options trading, penny stocks, or cryptocurrency, these methods are not recommended for everyone due to their volatility. However, if you're determined to explore these high-risk opportunities, here are a few strategies. 1. This involves buying and selling options contracts. It can yield high returns, but it requires a deep understanding of the market and can lead to significant losses if not done correctly. 1. These are low-priced stocks that can provide substantial returns in a short period. However, they are highly volatile and can be manipulated easily. Due diligence is crucial. 1. Investing in cryptocurrencies can be lucrative, but the market is extremely volatile. Prices can skyrocket or plummet within hours. Remember, these methods are not for the faint-hearted and should be approached with caution. Diversifying your investments and focusing on long-term growth is generally a safer and more sustainable strategy. If you found this video helpful, don't forget to like, share, and subscribe for more investment insights and tips. Your support helps us continue to bring you valuable content. Thanks for watching, and stay smart, savvy investors.